The broadcast is now starting. All attendees are in listen-only mode.
Hello everyone, good morning or good afternoon even, and welcome to the latest bite-sized tax highlights webinar. My name's Dominic Bourquin, I'm a tax partner at Monahans and I'll be your host for today. Today we're going to talk about three different subjects. The first one will be the Finance Bill 2013, which is now law as the Finance Act. There are two particular aspects I'd like to update you on. The second area we're going to cover is HM Revenue and Customs task forces and how they might affect you. This is becoming an increasingly useful tool to the revenue to attack what they perceive to be high-risk areas, and is allowing them to collect additional revenue, so they will continue to implement this task force type structure. And lastly, we're going to talk about a slightly different subject, which is tips for a better corporate tax system. Very often when the House of Lords or the House of Commons prepares a report on a particular area of tax, it may signal things to come. So I'm going to give you 5 different tips that were discussed at the House of Lords Economic Affairs Committee about how they might look to be improving the corporate tax system. So without further ado, or in fact with further ado, if you've got any questions before I start, just please do type them into the question box, and I'll either deal with them as we go through or I'll deal with them at the end, depending on how detailed they are. So without further ado, the Finance Act 2013 is now law, became law on the 17th of July 2013. Two major changes, both of which are additional pieces of legislation. The first one is the statutory residence test. That's now law, as is the general anti-avoidance rule. Both of these subjects were covered in the first webinar back in June, and I just want to give you a brief update as to where we've got to with their implementation and how they might work. So first of all, the statutory residence test. Effectively, it provides a roadmap for individuals to ascertain whether they're resident for tax purposes in the UK. The important thing to note is that these tests are now enshrined in law. They are part of statute, and therefore they cannot be changed by the revenue on a whim. The problem we've suffered from for a number of years is that we were subject to revenue guidance in respect of individuals' residence, and that has created uncertainty as the revenue, as facts change, the revenue changed their stance, and therefore that affected people adversely in terms of their residence status. The tests that apply to someone and that you must apply to an individual to see whether they are resident in the UK or not are set out in a prescribed form, and it really is a question of just working through them. There are wrinkles and complications along the way, but for most of us it will be a relatively straightforward exercise to ascertain whether someone is resident or not in the UK. So if you are concerned that somebody you're dealing with or somebody you're employing may not be resident in the UK, you need to be aware of individuals who you employ who perhaps conduct some of their duties abroad, those who perhaps regularly spend extended periods of time outside the UK. Maybe they go on secondment, or perhaps they have family abroad. Maybe they work on a particular type of contract that gives them, they work for 9 months of the year, take 3 months of the year off, but that 3 months of the year they spend visiting relatives in a different part of the world. The problem is that, like with most things, it's a bit of a drip feed, so you do need to be aware that different days, the number of days people spend inside and outside the UK do add up, so it is worth keeping a fairly detailed record to make sure that you or your employees don't fall foul of these new residence tests. So if we move on to the general anti-avoidance rule now, that's also law. Now, we covered this in quite a lot of detail back in June. I think the important thing to note is that it's supposed to counteract tax advantages arising from arrangements that are abusive, and those abusive arrangements must have as the main purpose, or one of their main purposes, the achieving of a tax advantage. All the revenues guidance on this and all of the consultation documents that were around prior to this becoming law stated that this general anti-avoidance rule was aimed only at the most abusive schemes. What I want to talk to you about today, though, is the General Anti-Avoidance Rule Advisory Panel. This is also enshrined in law and provides two functions. Firstly, it's a key check or balance in the application of the General Anti-Avoidance Rule and its application by the Inland Revenue. Clearly the Revenue will have a view of a particular arrangement, and they will decide whether to apply the general anti-avoidance rule to that tax-saving arrangement. If they consider that the arrangement is not a reasonable course of action, then they have to take that arrangement to the general anti-avoidance rule panel, who will provide a second opinion, if you like, as to whether that arrangement should be subject to the general anti-avoidance rule and counteraction. What's interesting is if the panel don't unanimously agree that the general anti-avoidance rule is applicable, then HMRC can press ahead anyway. But what I would say at this point is you can imagine the ultimate scenario is the Revenue have taken something to the general anti-avoidance rule panel. The panel have said, we don't think the general anti-avoidance rule applies, and the Revenue press ahead anyway. You then end up in court, and the judge asks the question, so what did the general anti-avoidance rule panel think of this particular piece of planning? And of course the answer is, well, they thought that the general anti-avoidance rule shouldn't have applied. So much as the Revenue don't have to take notice of what the panel say, I think it will be a key check or balance on their actions, because they don't want to look daft by pursuing taxpayers who haven't been perhaps as abusive of the tax system as the Revenue would like to think. Secondly, the General Anti-Avoidance Rule panel pre-approves HMRC guidance on the operation of the rule. So the Revenue's guidance is now part of law in terms of the operation of the General Anti-Avoidance Rule, but the panel must approve that guidance. So that's another key check or balance on the Revenue's actions in relation to this General Anti-Avoidance Rule. So the question then becomes, well, okay, we've talked about the panel. Who's on it? Well, we've got Patrick Mears heads it up. He is a partner, or formerly a partner, at Allen Overy Solicitors. And the panel comprises those other 6 individuals you've got listed down there. So there are solicitors, for example, Michael Hardwick of Linklaters, accountants, David Heaton of Baker Tilly, people from Commerce, Brian Jackson of Burberry. So it is a mixture of tax and legal professionals and business leaders. Most importantly, though, you will note there is nobody from HMO Revenue and Customs on that panel. It was a key point as this rule went through various committee stages in Parliament. It was decided that there is no way the Revenue should sit on this panel. The panel should not only be independent, but it should be seen to be independent, and therefore the Revenue should not have any representatives that sit on the panel. Probably also interestingly, we've heard in the newspapers and on the news recently about the Big Four accountants advising the government and Parliament on the implementation of certain tax laws. Importantly, therefore, in respect of this tax law, there's no Big Four accountant representation on this panel either. So there's no perceived conflict of interest between Big Four accountants who may have advised the government in a consultation capacity on the implementation of the rule, and then actually sitting on the panel that will physically implement the rule and decide which cases it applies to. So that's all I've got to say on the Finance Act 2013 today. So let's move on to HMRC task forces. Who, what, where and when. Well, the Revenue published a list of new task forces back in mid-July. They've raised more than £80 million since 2011, or even 20,111 as it says on that slide. Apologies for that typo. But they're also expected to raise a further £90 million per year over the next 3 years. The new task forces that have been published are focusing on those subjects there. So we've got road haulage in the West Midlands, restaurants in the North East and Lincolnshire, hauliers in the Midlands, but more importantly, perhaps for us down here in the South West, the holiday industry in the North West, South Wales, North Wales, the South West and Scotland. And when they say the holiday industry, they mean hotels, guest houses, B&Bs, and of course holiday homes and the rental of second homes. Just to give you an idea of how much they're expecting to recover in this area, they're expecting £5.5 million in North and South Wales from the holiday industry, and £2.5 million in the South West. How are they planning to do that? Well, what the task forces aim to do is to encourage traders to declare previously undeclared tax liabilities. So these are generally aimed at people who just haven't declared the amount of income they've received on their tax returns. Clearly, some industries are cash-based, and therefore they're at higher risks. And that's what the task forces are aimed at. They aim to undertake intensive bursts of activity in specific sectors, in specific locations in the UK, where probably through the normal inquiry process, the revenue have spotted there's if you like, a burst of under-declaration of tax liabilities. How are they going to achieve it? Well, they use a mixture of measures. Some they may start off with a telephone interview. They ring up a trader, they ask about the record keeping, they ask about who they deal with, they ask about the percentage of their transactions that are in cash, they ask how often they prepare their accounts, etc. And from the answers to those questions, they prepare a risk questionnaire, which will effectively give them some sort of idea as to how risky that particular trader is. They may follow that up, they may not. However, where they think they know there's a perceived problem, they may well just visit the trader, and that may well be an unannounced visit, so they will just turn up to premises. The last method they use is just a normal compliance check, which would be a letter with certain inquiries into the areas of risk that they perceive to be the problem. Our advice, if you're subject to a task force type inquiry or any sort of inquiry, is to cooperate initially with HMRC, but you do need to talk to your professional advisors as soon as possible. My experience of HMRC is that if you allow them to, they will let you do an awful lot of their work for them. So you can supply them with your records, they'll then have you photocopying those records, providing copies, your staff will be digging around in other records for them, etc. You don't have any duty to help them other than to provide them with the records. So if you are concerned about what the revenue are doing and you think that you need assistance, then do involve your professional advisors. The other thing the revenue may seek to do is to ask for documents they're not necessarily entitled to. So, for example, they may be investigating a company and they ask for the bank accounts of the individual shareholders. Now, if there's nothing in the company's bank accounts or the company accounts that intimates there's any transactions between, other than normal dividend or salary type transactions between the shareholders and the company, then they don't really have any right to those records. So it's very important, if you are the subject of a task force type inquiry or any sort of inquiry, that you involve professional advisors to make sure you don't do the revenue's job for them. The last subject today is 5 tips for a better corporate tax system. We've all read in the newspapers and heard on the news, on the television, about companies like Amazon and Google and how bad they are because they haven't paid their tax, etc., etc. Well, the House of Lords Economic Affairs Committee is currently considering whether there should be a new approach to taxing global businesses. Clearly, there are 2 sides to every story. Critics would say, well, these big global businesses, they're immoral, they should pay the right amount of tax, and they use legal loopholes, and they're able to use the fact that tax rates are higher in certain countries and lower in others to move profits around, etc., etc. Those companies and some accountants would argue, well, the government set the laws, so change the law. If you don't think you're getting the tax take you need, then you need to change the law, which I can also see that point of view as well. So the House of Lords set up this inquiry. Accountants and other trade bodies provided commentary. They provided suggestions as to what they would do to improve the corporation tax system. So, tip 1: tax medium and small and medium-sized businesses as if they were partnerships. There's always an issue where you've got a company, between the company paying its tax and then the individuals trying to get their money out of the company without paying the minimum amount of tax. If you taxed the small and medium-sized businesses as if they were partnerships, there wouldn't be any problem extracting cash from the company because the profits would be taxed on the shareholders as if the company was an individual. That would remove remove the impetus for planning around cash extraction from companies. Quite an interesting option, I think, that one. The next 2 tips are actually completely contradictory, believe it or not. Tip 2 was from the Chartered Institute of Tax, who effectively said, well, enterprise investment schemes, which are tax advantaged investment schemes, so if you invest in such a scheme you will receive certain tax breaks, they argue that perhaps they're not really an incentive and perhaps they just reward investment that would have happened anyway. I would counter that and say, well, actually, you may find the tax breaks for these sorts of investments are actually what pushes them over the line. Without the tax breaks, you might find the investment didn't actually go ahead. However, if we move on to tip 3 was from the Venture Capital Trust Association, who effectively said we need to expand tax breaks for higher risk business investments. They say that the current technical requirements for the enterprise investment scheme and other venture capital trust schemes are actually too restrictive. So we'd actually lower the bar to allow more business entities to take advantage of those schemes, and we should also expand it to all business types. Most of the venture capital trust type schemes only apply to companies, so we should open those up to partnerships and other business entities as well. So it just shows you've got two different bodies there going in different directions in terms of the same area of the tax system. Tip 4 is also an interesting one. There's estimates indicate that 50 times the salary cost of a revenue officer will be generated by dedicating more staff to looking at larger corporates. This came from the Association for Revenue and Customs, which is effectively the HMRC trade union. And of course they followed up there, well, we could get you 50 times the salary cost of a particular revenue inspector if they focus their efforts on larger corporates but morale's very, very low, and tax experts in the private sector earn more money, and so I think we should reduce the pay differential, i.e. we need to pay those inspectors more money. Now, that may be a reasonable assumption, but from what we've seen from the government's attitude in recent years is that they're actually cutting revenue staff, and the revenue staff that are left are being more heavily focused on certain areas like the task forces we've just discussed. So I'm not sure that this particular tip is going to be going any further forward, but no surprise we have a trade union trying to increase the pay of their members on. Tip 5 is perhaps something that may well go forward further. This is that they introduce a country-by-country reporting standard, so all companies are required to report how much pre-tax profit they make in each country. That is aimed at, I suppose, the likes of the Amazons and the Googles of this world, and it shows how much profit they actually make in those countries, because then, of course, the revenue authorities in those countries can work out exactly how much tax they pay and whether they are paying the right amount of tax. I say the right amount of tax in quotes. This may have some mileage in it. I think it will just make company reports even longer and even possibly more impenetrable. As a bonus tip at the end there, make the corporation tax rate 11%. I read 2 or 3 months ago in one of the national newspapers that there was a certain amount of commentary around reducing the corporation tax rate below where it is now, and clearly it will come down to 20% from the 1st of April 2015 for large companies, which is pretty low. But the article that I read said, well, if you bring it down to 11%, you won't have a problem with Amazon and Google taking their profits elsewhere. They'll leave their profits in the UK, and therefore overall the corporation tax rate will increase. The corporation tax take will increase, despite the fact the rate is almost half what it would have been. I think that shows, those 5, 6 things show you the difference that there is between certain people and their views of the tax system. It's very difficult when you've got a wide-ranging and complicated tax system to get consistent opinions, and as you've seen, some of those opinions are actually contradictory from 2 respected trade bodies. My own view is I think we need to simplify the system, and that's not because I'm an accountant and want to take advantage of those simplifications. It's because I think if you simplify it and you lower the tax rate, more people are liable to report more profits, because they're more easily able to do so without the compliance costs, and they're also going to be taxed less on what they do declare, and therefore they're liable to declare more. That's all I have for you today. We will be online again back in early September. I hope you have a good summer. You will be sent these slides. Thank you very much for attending. I look forward to engaging with you next time. Thanks very much.